Howdy out there, folks. This is Darius Dale here to present our macro minute for Thursday, February 24th, 2022. Starting with markets, we obviously have stocks down hard this morning, commodities up on global supply concerns, crypto down big, dollar up big, global bond yields down big. Big movers, both Germany's DAX and the emerging MSCI Emerging Market Index, both off around 5% apiece. Bitcoin down around 6%, Ethereum down around 9%. WTI crude oil just to the moon, up around 8%. VIX to the moon as well, up around 20%. And then to me, the most shocking day over day move in markets this morning is the decline, the 25 basis point day over day decline in the 10-year TIPS yield. That's a 42% decline, leaving it around 0.83%. So big move in terms of repricing real interest rate expectations in the long end of the Treasury bond market. Shifting gears to the macro front, nothing material day over day in terms of calling out, particularly on a day like today. So what I thought was he'd actually, spend some time, put together a few slides for you guys to help you think about contextualizing this setup. Taking it just taking it to the charts here. Remember this chart as the header, right? We put this slide together on the heels of the October CPI print in the U.S. economy. I want to say it was in the second week of November, and we featured this slide pretty consistently in all of our research since. And it's really just a handy guidepost for investors to understand where we are in the market cycle as a function of the broader economic cycle. So the blue line shows the OECD composite leading indicator time series. That's a proxy for global growth. This time series leads inflections in the GDP cycle, typically by 1 to 2 quarters. Pick your economy. The black line shows the high S&P 500 high beta, low beta ratio. So that's high beta stocks prices relative to low beta stock prices. And then the red line shows Bitcoin to treasury bond prices ratio. And so what we typically see is that, in these global growth down cycles, of which the US is obviously participating, we typically see anywhere between a 30 to 35% correction in high beta stocks relative to their low beta counterparts. And then we also typically see a, let's call it 75 to 85% decline in Bitcoin price relative to treasury bond prices. And as you can see in this chart here, we're very clearly careening down the backside of the global growth cycle. But if you look at our forecast, for not just the U.S. economy, but the whole global economy, we're going to be careening down the backside of that global growth forecast, as indicated by the I's and D's. It's inflation and deflation in our grid regime process. That those are the two grid regimes where growth is slowing in both. We're going to be slowing for quite a while. And so taking it back to this chart, the blue line is going to continue heading down over the intermediate term. And the reality is it's very likely to see a big decline in the red line and the black line from here. We've already seen a lot of pain in those types of securities and assets, but the reality is we haven't seen anything yet to the extent we start to understand the impact of not just Fed tightening, but global monetary tightening and global fiscal tightening as we progress throughout this year. So just wanted to remind people that blaming Putin and Ukraine is a lazy person excuse. When we sold Bitcoin in early December, it wasn't because of Putin and Ukraine. When we told you to get out of high beta stocks and high beta risk assets in general back in November, it wasn't because of Putin and Ukraine. It was because of the color coding associated with this table and the many thousands of data points that our models are picking up to generate the color coding in this table. So just one final thing to highlight, just we're in a growth slowing regime. And what that means is we're in inflation or deflation. And what you typically have is volatility, realized volatility for something like the S&P 500 is typically 50 to 70% higher in these regimes relative to what it would be in a growth accelerating regime. And you typically see that much higher levels of volatility if you look at something like the S&P 500 high beta index, which I'm showing here as a proxy for high beta risk assets. So, the reality is this process is very sophisticated. It's not for everyone to just pick up and understand, but certainly you can understand the outputs of all the component parts of our process, which we're obviously making available to anyone who wants to subscribe, but more importantly, anyone who wants to tune into our YouTube channel, tune into the Real Vision Daily Briefings, tune into the mini podcast that I'm, we're sort of, sort of disseminating this information, this high value macro risk management content for. So hopefully you're paying attention. I can't tell you to respect your focus budget. I'm going to continue to respect mine and want to make sure that everyone understands that, hey, look, this process works and it works for a reason. We stand on the shoulders of giants like Ray Dalio, Danny Kahneman, Benoit Mandelbrot, regime segmentation. Ray Dalio, godfather of regime segmentation. Danny Kahneman, Amos Tversky, the godfathers of prospect theory, which is the foundational principle for why rate of change is the dominant force in financial markets. And then lastly, Benoit Mandelbrot, the godfather of risk management himself, which is why volatility is a leading indicator for price. So again, come check us out at 42 Macro. If you can't afford it, subscribe to our YouTube channel. Check us out on Real Vision and all the other programs that we're on. Getting back to today's probable range setups, overbought signal in nat gas, 2-year inflation swaps here in price in dollars, silver and gold, oversold signal in the S&P 500. You got British pound, 10-year bond yield, 10-year treasury yield, 30-year treasury yield, 10-year tip yield. S&P 500 that is still neutral VAMs would very very narrowly, very clearly would break to bearish VAMs if some of the smoothing indicators just roll forward in time over the next few days. But that's at the lower boundary of its probable range now with 9% of upside. WTI still neutral VAMs. OVX, that volatility signal continues to be in the wrong regime for that to be a raging bull signal. But obviously price is raging bullish. But that's got 15% of downside versus 1% of upside in its probable range this morning. Bloomberg Dollar Index, still bullish VAMs minus 1.1% of downside versus 0.6% of upside in its probable range this morning. 10-year treasury yield still bullish from the perspective of our volatility adjusted momentum signal, although I suspect if we continue to keep this up, it won't be bullish for very long. That's at the lower boundary again of its probable range with 36 basis points of upside. Bitcoin, bearish VAM still minus 2% of downside with 21% of upside. Ethereum, bearish VAM still minus 6% of downside with 27% of upside. And then lastly, gold minus 7% of downside, and it's at the upper boundary of its probable range. Still neutral bands as well. Again, that 10-year tip shield signal, which is what we're using for the volatility adjustment for gold, is not quite at a level, both on a realized and also on a smooth basis, to suggest that gold is in a raging bull market. But I suspect if we continue this kind of price action up over the next ensuing days and weeks, we're going to start to see a lot more phase transitions from the perspective of the volatility adjusted momentum signals in our global macro risk matrix. So stay tuned for that for all you 42 macro subscribers out there. So with that, Darius Dale presenting our macro minute. I know it was longer than a minute this morning, but I think you like it. So we'll catch you back here tomorrow, Thursday, February 24th, 2022. Cheers.